Hello and welcome to It's the Economy. It's been a long gap because I have been in the University of Chicago for a program for journalists. But because it's Chicago, the topic today is the US economy. Data has been all over the place. As we know, inflation data for February and March came in higher than expected. But the jobs number for April came in far lower than expected, indicating that the economy may not be that strong after all. So obviously, the Fed funds rate expectations are all over the place. I have with me someone today who's best placed to guess or guide how interest rates might move. I have with me Professor Anil Kashyap, Professor of Economics and Finance at the University of Chicago Booth School. Give me a minute to tell my viewers why Professor Kashyap is best placed. He has been an advisor to almost all the major central banks. He has advised the ECB, the Riksbank, that's the Swiss central bank. He has been a member of the Federal Reserve of New York and Chicago. He's advised the cabinet office of the Japanese PM. He's a Japan expert. Until very recently, external member of the Bank of England. So, best place to speak about global economy as well. Thank you very much, Professor Kashyap. First up, the inflation numbers. We've seen that, shocker in February and in March in the US, and that's disturbed the market expectations. Can we now see a tapering off? What's your best estimate?
Well, there's a lot of indications that inflation is going to be pretty sticky, so I don't expect it to just harmlessly trundle back down to 2%. It seems like it's stuck around 3%, and that wouldn't be historically so surprising. This idea that it was just going to come right back down without a period of slowing in the economy is kind of doubtful. So I think inflation may be more elevated than the market thought, certainly at the beginning of the year, but even now, I think the markets may be a little bit too optimistic.
Okay, well, since you said growth, I'll first come to that and then come to your Fed expectations. Growth has actually been a little weak after 4 quarters all through 2023. GDP surprising hugely on the upside versus estimates. The last number is way lower, 1.6 versus market expectations of 2.3. Likewise, jobs data, 175,000, markets stood at about 2,500. So isn't that weakness?
Yeah, but it's second order. I mean, the economy's still doing quite well. The unemployment rate's below 4%. I mean, nobody thinks that that's the level that is consistent with a slow economy. And so I think jobs are still plentiful. I mean, maybe a little bit less than last year, but I think the economy's held up pretty well. Part of what hasn't gotten so much attention is the way the economy would normally slow after the interest rate hikes that the Fed put in. 2 of the sectors that would be very, very depressed normally are auto sales and construction. And auto sales are still catching up from the pandemic. It was very hard to get a car in the United States because of semiconductor problems and so on. So it's still the case that if you want to buy a car here, there's a lag. So auto sales haven't collapsed the way they would normally have. And then the fiscal support for infrastructure spending has been massive. So construction would be another place where you'd expect to see the weakness. So you've got 2 of the most cyclically sensitive parts of the economy not really responding. If that's the case, then you're probably not going to get a huge slowdown.
Okay, so then what's your best expectation about when inflation might trend down to the satisfaction of the Fed? And then the big question, what are you expecting from the Fed? When is your first rate cut estimate?
Yeah, I don't think they're going to cut rates in the first half. Well, I guess we're almost at the end of the first half, but I think maybe in September, but I think that's far from certain. I could easily see a situation where they don't cut at all. There'll be a political dimension to all of this. The Fed tries to stay out of the economy. It's clear that Trump will blame them for anything that they do that would be taken as supporting Biden. So if they cut rates in September, it's going to be pretty close to the election. I think they'd have to have clear evidence that inflation had fallen at that point to do that. Otherwise, they'll probably just wait another meeting or so. And I can't say I blame them. If you can't tell, the last thing they want to do is signal that they're kind of declaring victory. They don't want to have to reverse it. And historically, once they start cutting, they're going to keep cutting. So the markets will pull forward as soon as they see the first cut, a lot of stimulus which means if the inflation isn't under control, it's probably going to creep back up. So they're in this kind of dance with the markets where every time they say something that sounds a little bit dovish, the markets go crazy, and then that supports the economy, and then they say, well, we're not there yet.
So in your estimate, it's probably the earliest is September. The market is not very far from that. The market's veered to September. But there are a lot of people still expecting 3 cuts.
No, there's no chance that.
Correct. Well, that's a very important learning in that case. What do you think the Fed will do about quantitative tightening? If they're this worried about aggregate demand in the economy and economy not slowing, is the quantitative tightening going to continue?
Yeah, I think they're mindful that they don't want to starve the economy of the reserves and liquidity. And so I think all else equal, they will be a little bit cautious. They already had one scare in 2019 where they got the balance sheet below what the financial system seemed to require. And so I think they want to be cautious about that. On the other hand, if they had their choice, they would run it down as far as they can because they're balancing that.
Okay. In that case, let me come to the fisc as well. Before I ask you about market rates, the fisc. The last quarter numbers that we got, the spending was still very strong. So do you see that continuing? And if that happens, what happens to market rates? Even if there is a rate cut and there's such a huge supply. So do you think 10-year yields continue to hug 4.5?
I don't know. I think it wouldn't be unreasonable. I mean, the deficits that we're running now, even with the strong economy, are unsustainable. There's no way that we can pursue this level of imbalance between taxes and spending like we've been on for the last 5 years, basically. And we're well past the end of the pandemic. There's no need for extraordinary looseness. And so I think we've got to tighten up a little bit of the spending, but probably have to raise taxes to do that. And so I think the risk that the market becomes concerned that the U.S. fiscal situation is not in a good place is growing.
Okay, it'll be a while before they start cutting the deficit, you think?
Yeah, I don't see any chance it happens before the election. So there's no chance that's going to happen.
So the steepening of the curve, the steep curve remains in that case.
It could.
Okay, but if the fisc is going to lessen its support, as you say, it should, and Warren Buffett was talking about higher taxes. And if the Fed remains tight, practically one or no cut this year, then are we looking at some serious slowdown in the economy by the last quarter?
No, it doesn't have to be that way. I mean, the level of interest rates is not that restrictive given where inflation's running. And financial conditions on the whole are pretty supportive. So I don't think it's the case that the Fed has really stepped on the brakes so hard yet. And that's the question. So if they end up leaving, policy being slightly restrictive for a while, it'll take a longer time for the economy to slow.
Then a quick word on the global economy. Do you expect ECB and BOE to cut sometime sooner than the Fed? And what's the growth situation there? I want your idea of the global economy as well.
Well, I think that the economies are less synchronized than usual. The war in Ukraine is still a big deal for the European economy. And, forecasting how that's going to go is very, very difficult. I mean, if Mr. Trump wins, I think he will quickly kind of cut a deal with Russia to try to get rid of that problem as far as he sees it. And that could be very chaotic for Europe. So I think that's a big meta uncertainty. Middle East looked like at one point that we're on the verge of a huge fight between Israel and Iran. That would also be very, very disruptive, again, an energy price shock. So there's a lot of downside risk in the global economy. I think Japan is a place where there's some good news. They've managed to end their yield curve control without having the markets throw a tantrum. They'll begin starting to normalize. We'll see how they're able to do that and whether they can tighten a little bit. So the direction of what the central banks are going to do is more divergent than it would usually be.
Okay, so a last word on the global economy. If you could elaborate a little more on Japan, I mean, we continue to see Japanese yeens strong enough to attract their big, investors in India, in EMs. Does that money go back there because Japan will give better returns? And, does the global economy slow this year at all? For a country like an EM like India, that's really important.
Yeah, I think it's hard. I mean, I think the different regions are in very different places. The risk of a China-U.S. Kind of confrontation are going to remain high for quite a while. And so that can overwhelm whatever else is going on if that were to really materialize. I think as far as Japan, I mean, they're going to first have to hike rates a little bit. I mean, it seems that they're intervening to try to keep the currency from depreciating further, but they haven't been as forthcoming as they usually are about this. So I think that's something to watch. I think it's okay if the yen weakens for a little bit because that's the way that the inflation will get entrenched. And I think they'd be better off living in a world with that inflation rate Japan of 2% than minus 2% or minus 1%. So it's okay.
But overall, you do expect the global economy to remain jittery because of geopolitical reasons.
Yeah.
Dr. Kashyap, it was a pleasure speaking with you. Thank you very much for this encyclopedic view of the global economy. So key takeaways for us. First, the US rate cut perhaps may not happen, and if it happens, perhaps one. But more importantly, the US election is a binary event. In case of a Trump election, we can see huge geopolitical changes. So we need to fasten our seatbelts. That's it on this edition of It's the Economy. Thanks much for joining.